Most people have no idea what's coming. Yesterday, November 20th, the Federal Reserve Governor Lisa Cook revealed what I warned you about just 24 hours earlier, a $2 trillion private credit bubble that could trigger the next financial crisis. The market tanked immediately. NVIDIA had stellar earnings, beat guidance, raised guidance, but dropped 7% on the day. Now, when good news crashes the market, that's your warning sign. That's one of the things I learned from my mentors. Good news, bad reaction, you better pay attention. And what no one's actually talking about is that there is this $800 billion AI infrastructure funding gap, and that ties into this. Now, the government is planning to fill it with your money to prevent a total market meltdown. My name is Felix Prehn. I'm a former investment banker. I've studied for years how Wall Street actually operates. I'm also the founder of the Goat Academy, where we've taught over 20,000 students how to protect and grow their wealth. I'm also the co-founder of TradeVision.io, where we provide news and data that's better than what anyone out there gets as retail. So I'm dedicating my retirement to teaching regular investors, which is what I used to be, still am really, how to protect their wealth from the schemes and the financial engineering that Wall Street uses to transfer wealth from the unprepared to the prepared. Now, for this video, I've analyzed everything that happened in the last 48 hours. The Federal Reserve meeting minutes, the institutional trading data, private credit market reports from the IMF, the Bank of England, the Fed, and the actual congressional testimonies about the AI bailouts. I fact-checked every single claim you're about to hear, with help, of course, from Winston, who's hiding here somewhere, and my furry gang. I'm today going to break down 3 critical things that are about to reshape your financial future. 1, the private credit time bomb that the Fed just exposed. Well, I actually told you about that before, but, subscribe to the channel. And the risks, by the way, look exactly like 2008. Remember 2008? That wasn't pretty, was it? Number 2, we've got the secret government bailout plan to bail out AI companies and private credit firms using inflation and money printing. And then number 3, how can you position yourself to profit massively from this wealth transfer instead of becoming its victim like you probably did in 2008. So by the end of this video, you understand exactly how to protect and grow your wealth no matter what happens. Pretty big promise, right? Now, let me put this in real numbers for you. Yesterday, the S&P 500 did something it only does 2 other times in history. It gapped up more than 1.4% at the open. So the open was glorious. I don't know why I'm using a red pen. Bit gloomy, isn't it? On the open, we went up 1.4%. It looked fantastic. And it completely reversed and it closed negative. Now, the last time that happened was April 2025, Liberation Day, right? And before that, April 2020, COVID crash. But this one is different and more scary. The private credit market has exploded from $375 billion to now $2 trillion. 400% plus increase. The IMF says it's going to hit 3.5 trillion by 2028. Deutsche Bank, Bain & Co., they just at the same time said there is a massive funding gap for AI. These companies need $2 trillion by 2030 just to break even on infrastructure costs, but they're nowhere close. NVIDIA, the poster child of AI, reported amazing earnings, yes, beat estimates, raised guidance. The stock should have soared, but it dropped 7%. The Nasdaq swung 500 points from high to low. And the market crashes on good news. That's not a correction. That is a serious warning for you that you should pay attention to. Think about it this way. Imagine if your household made $100K a year, but you owed $100,000 in debt, and that debt was growing every single year. You're paying a fortune every day just in interest. More than you make in a month in interest just to service it. You can't cut expenses without crashing your lifestyle. You can't default without destroying your credit forever. You're trapped. That's America right now. And the only way out, print more money, bail out the companies that are too big to fail. Does that sound familiar to you? It's not the first time we've seen this. Let me walk you back through history, because those who haven't learned from it are doomed to repeat it, right? The 2008 financial crisis, what happened? Banks packaged garbage mortgages into AAA-rated securities, and they called them CDOs, collateralized debt obligations. They were these weird, opaque, illiquid, filled with rubbish instruments. Nobody knew who helped them until everything collapsed. Lehman Brothers went under. The government bailed out the banks with $700 billion of your money. And now those who were prepared, those that had cash, they made a fortune because you could buy good assets at like a 50 to a 70% discount. I remember that very well because I had a great mentor and he said to me, buy these bonds from these banks. And I did. And I bought some of them at a 70% discount. So it went from 30 cents up to 100 cents. And I made all that money. It was glorious. But I know a lot of people lost their shirt. We can go back even further. 1971, the US had too much debt from the Vietnam War. Nixon decoupled the dollar from gold. Temporarily, yeah. What happened next? Well, inflation destroyed everything. Gold went from literally $35 per ounce to $800 by the 80s, 2,200% gain, right? Or 300% gain. Now what's happening today? Private credit is what the CDO was, but nobody understood. Nobody knew what CDOs were, right? Except for a few bankers. Today, private credit risk is the same thing. Nobody knows what the heck that means, but it has the same problem. It's opaque, as in nobody knows what the heck they own. It's illiquid. There is very weak underwriting. There is hidden leverage. Jeffrey Gundlach, the billionaire bond king, just called it the Wild West and said it was the same trappings as the garbage lending before 2008. The governor of the Bank of England, that's their Fed chair. He's called Andrew Bailey. I think he used to be the Canadian governor as well. He just said there are worrying echoes of 2008 in private credit markets. The IMF issued a warning. If private credit remains opaque and continues to grow exponentially, its vulnerability could become systemic. That's a polite language for global financial crisis. But there's a difference this time. In 2008, we passed regulations to make banks safer. That's why private credit exists. Because yes, banks are more regulated. So how do we get around that? Well, why don't we lend out of organizations that are not banks? Now, there's no banking regulation, right? That's how Wall Street operates. All the risk moved into the shadow banks. So it's back, it's bigger than ever, and it's connected to the AI infrastructure that the government says is too important to fail. So what's the solution? Well, here's what won't work. Printing more money, that leads to hyperinflation. Your savings, your fixed income, your cash, your salary, all worthless. We've seen this playbook, right? I mean, Weimar, Germany, that's where I came from. Venezuela, Zimbabwe, it destroys the middle class. In the US, that is happening, but at a slower pace, so people don't notice. You could also go for austerity. Well, politically impossible because no one's going to vote for less, right? So it would also lead to the economic crash because, yeah, the government is such a huge part of the economy now. So no one's going to vote for that. That's not happening. Well, you could default on the debt. The US government could default. Well, that would obliterate the dollar's reserve currency. The world economy would be over by the end of the day. So that's not happening either, right? So what else could we do? Raise taxes? Well, you need to tax every American an extra $266,000 per household just to pay off the debt. And we're adding more to that debt every single day. So the math doesn't work. Grow the economy? Well, you'd need to get 8 to 10% GDP growth. And I know, there's some Trumponians watching and, I don't care about your politics particularly, one way or the other. I have no real interest in US politics other than how it affects my portfolio. But this is highly unrealistic. Yes, tariffs bring in some money for sure. That's a positive, but it's nowhere near enough. That kind of boom, it just doesn't last. Like you see it after world wars or something, but you don't see it continuously. So every traditional path leads to just disaster. It leads to Japan, which is also collapsing as we speak. So they're choosing, therefore, another path. They're choosing the hidden path. See, I put that in here very faint. Only one path works. Controlled wealth transfer. That's the secret, which is why it's on the slide in such light color. Strategic inflation and strategic bailouts is how this works. So what do? They basically keep interest rates low artificially. That's happening, right? There's probably going to be a December Fed cut. If there won't be, it'll be loads of cuts by the mid of next year. And the important companies, like your AI infrastructure companies, your private credit firms, they'll tell you that they are important for national security or competitiveness with, adversaries or something like that. So what do? Well, asset prices go up, stocks go up, real estate goes up, gold goes up in dollar terms. So if you own assets, you get richer, right? I'm not too worried about this personally. But I know a lot of people are, and they should be, because they need to act, they need to be in assets. If you hold cash, you get robbed through inflation. It's the most politically acceptable solution, though, because most people don't understand it. They see their paycheck and they think, I'm okay. They don't realize that the value of the money that they earn is being drained by maybe 5% or 10% every single year. And Wall Street doesn't want you to know this. The crucial skill isn't picking what to buy, it is actually knowing when to sell. Most investors focus on buying. That is actually wrong. The real money is made by having a rule book for selling. Right? That's what separates retail investors who lose from professionals. So before I show you exactly how this wealth transfer works and which specific assets you need to know, in my humble opinion, not financial advice, I want to invite you to something better than this video. A live training with me, live, we'll do about 2 hours on Saturday, where I will walk you through the actual rules that Wall Street traders use, that I learned from my old boss, from my mentors, and that have been in use for over 50 years. And yes, that work even in this crisis. It works in the AI bubble. It works after the AI bubble. It'll work in the next bubble because it's been working for 50 years. You want to learn those actual rules? Come and join me on Saturday. And you can do that by going to felixprehn.org/training. It's completely free. Here's the link, and it's down in the description as well. And I'm going to give you the rule book, right? What to watch out for, how to protect yourself, and so on. And you can also ask me a ton of questions. So you basically get a sneak peek into exactly what I teach my 20,000 plus students. Exactly what investment bankers talk about. Exactly what the big traders do, right? So let's dive a little deeper into this and understand this. Remember that Fed Governor Lisa Cook warned yesterday? Well, let me show you why this isn't a conspiracy theory. It is financial reality backed by hard data. On November 20th at 11 a.m. Eastern Time, the Fed governor gave a speech about financial stability. She specifically warned that officials should monitor how unexpected losses in private credit may spread to the broader US financial system because of increased complexity in the interconnections with leveraged firms, which sounds exactly like 2008. Now, what's critical? It's the timing. The market was up huge in the morning, and NVIDIA crushed their earnings. Everything looked absolutely fantastic. And then the Fed drops this bombshell at 11 a.m. Obviously, not that many people watched my video 24 hours earlier. We need more subscribers. Share this video. So we had a terrible day. The NASDAQ dropped like 5% from high to low in a day. That's crazy, right? But I told you. There's a video out there to prove it. You can watch it. Go back to watch it. I warned that private credit was the hidden risk everybody is ignoring. The Fed just confirmed it, so let's look at the evidence. IMF warned it, right? Bank of England, the governor of the Bank of England warned about it. Worrying echoes of 2008 were his words. Jeff Gundlach, the bond guy of bond guys. He says it's the Wild West out there. It reminds him of 2008. The Fed has published research that banks are increasingly lending to private credit firms. Imagine that. We have regulated banks, right? So you have a bank here that is meant to be regulated, and then you have the Wild West of the private lending, me lending you something that would be unregulated, right? So you'd think these are two different worlds because this one here is safe and regulated, but the problem is these banks are actually lending to the private lenders. So in reality, all this garbage in private lending will hit the banks. So if private credit fails, it hits the banks. The banks are threatened. Well, what happens? It's 2008 all over again, right? So it's not speculation. It's pattern recognition, which is what I do. And it's based on data from the world's top financial institutions. So what's happening here right now? Well, there are two things the government basically needs to do. The government needs to keep rates low. That's happening, right? New Fed chair is going to come in and he's going to be a poodle. The government's going to print money like there's no tomorrow. And then it's going to subsidize, bailout companies like the ones who really need the money. OpenAI, Microsoft, Meta, right? These huge profitable companies, because they're building all the data centers. And those data centers cost hundreds of billions of dollars. And if they don't build them, then the US think they're going to get left behind in the international AI arms race. So without government help, this isn't going to happen. Now, the second thing is private credit, those $2 trillion in loans. Many of those loans are bad. Private credit collapses, the banks collapse. The banks are threatened, the Fed has to step in, otherwise the whole tinderbox goes up in flames. So how are they going to do that? Are they going to just bail them out? No, that would kind of be too obvious. What they're going to do instead is literally just keep printing money and shove that money into those banks. The odds of a Fed rate cut jumped by 35% yesterday. So the market is suddenly going, we know what's coming. But most of us out there, retail investors, we don't know what's coming, right? Look, maybe you don't believe me on this. Maybe you think this is just a doom and gloom video. It's not. I'm going to tell you what to actually own in a second. But before we do that, let's understand this. How is this going to work? Is the US government, so if this is the US government, are they just going to send money to, say, OpenAI? That would be incredibly unpopular, right? So they're not going to send money. They're going to guarantee some sort of loan. I mean, literally, OpenAI has asked for a government backstop, which is a loan for data centers. Elizabeth Warren, that senator I can't bear, I don't know why, she just makes my skin crawl. She sent a letter demanding to know if the Trump administration is planning AI bailouts. So obviously the government is talking about it. The second way they're doing it, and that's already happening, tax credits. Remember that whole semiconductor manufacturing tax credit bill that Biden cooked up? That is now including AI infrastructure. So they're already getting money into these OpenAI and Microsofts and Oracles and so on. Now, for the actual private credit, because that's even less popular, they're doing it in a more subtle way. So you've got your private credit companies down here. If I could spell private credit, you get the idea. How can they bail them out? Well, here is what actually happens. You have a bank above. Above that, you have the Fed. So the Fed provides money to the banks. The banks provide credit lines to private credit. So if nothing goes bad, the Fed doesn't have to do further. But if something does go bad with private credit, and it very much looks like it is, then the Fed steps in to maintain financial stability. We've seen that movie before, right? So what happens? Well, essentially, the Fed has to create more dollars so they can send more dollars into the banks, so that the banks can send more dollars to the private credit companies. Now, where are those dollars going to come from? Well, you print them. Right? Means you don't get more debt, no austerity, you don't raise taxes, you just print more money. Now, what does printing more money do? Well, it bails out these important entities. But really what happens is your money loses value, significant amounts of value. Now, I could walk you through what happened in the 70s and Vietnam War and everything else, but I'm not going to really get into that because we've covered this plenty of times before on this channel. But let me just give you one number. In the 1970s, inflation was about 7% per year. Now, they have since cooked the inflation measure so much that it no longer shows you these high numbers, but in reality, it's still there. I mean, for me, real suffering, hotel rooms that used to cost me $200 a night now cost me probably $1,200 to $2,000 a night. That's some real inflation for you, right? Real suffering there. You could just go and stay in a cheaper hotel. I do hear you, yes, but we don't want to go that far, do we? So what happened in the 1970s? Over the 1970s, people lost half their wealth. $100,000 went to $44,000 in purchasing power. Crazy. At the same time, the people who owned assets made like 2,000% gains. So what do you want to own right now? Not financial advice, my humble opinion, do your own bloody research. But I think owning tech is going to get bailed out as long as you can handle the ups and downs. Energy, financials, the good ones, not the crap ones, and defense, because there'll always be war, right? Real estate, yeah, REITs maybe on data centers and industrial stuff. Don't do the residential. That would be my thought. Commodities, gold and silver, industrial metals, I think will do well. Those are inflation-protected assets. They have pricing power. Microsoft has pricing power. Netflix has pricing power, right? Pepsi has pricing power. Google has pricing power. Meta has pricing power, which just means it's very hard to replace those guys. But what do you not want to be in? Don't be in long-term fixed-rate bonds. They get crushed, absolutely crushed. Being in bonds can be a good thing, but you need to know which ones. If you don't, just don't bother. Having lots of cash sitting idle because you're waiting for the crash, well, as Peter Lynch says, more money's been lost waiting for the crash than in the crash. Don't do that because inflation is definitely going to kill you. And don't own speculative garbage, right? A lot of retail investors own lots of this because they tell a good story. Now, a lot of the time, these stocks are out there because these stocks do a lot of PR, not so good on the management. Now, this channel, I promise you, I never have, I never will take money from any company that we ever talk about, right? If I ever own a stock that I talk about, I'll tell you, because I think that's the honest thing to do, and we don't need to do that kind of thing. You'll also notice we don't have any affiliates, so we don't have any, like, go open an account with XYZ brokerage because of, I'm going to get paid. We don't do that. Yeah, very simple. The only thing we actually offer you is education with my mentors. That's it. And free training on Saturday, felixprehn.com/training. But we've seen here before. We've seen this movie play out before. I had friends who worked at Lehman Brothers when it failed, right? There is a playbook here, and it's repeating once again. Now, I have a couple of rules that I learned from my Wall Street mentors, and let me give them to you. Never let a winner turn into a loser. Big rule. Yeah, you were up 50%, now you're at 0, who cares? Get the F out of it. That would be my default. You obviously have to decide yourself. I can't, give you personalized financial advice. You want to have trailing stops. We can debate the exact percentage where that sits, because it depends on what you own. If you own a lot of this, like, speculative garbage, you're going to have to take more risk. If you own better stocks, then that might be a reasonable requirement. Some rebalancing can be a good idea, but again, we want to let winners run. But when the fundamentals change, you want to get the F out. Again, if you want to understand fundamentals, come and join our community and we'll teach you about it. But at the very beginning of it all, you need to have an exit plan before you enter. Now, if you're already in there and you haven't got an exit plan, well, now is the time to make the exit plan. Don't wait for it to get worse. Hopium isn't going to get you very far. These 5 steps are the difference between the pros, you'll still be there, and the retail investors will cry about it later, right? So what are we looking at here? I'm looking at 6 to 12 months of choppiness. I'm looking at some opportunities. I think Trump's going to pump the market for midterms, just my humble opinion. By the way, I always get killed for criticizing politicians. When I was criticizing Biden, I was like, you're a Trump, fan and whatever. And now I get killed by people who think I'm the opposite. Like, whatever. I don't care. I don't care who's in the White House. Not my country. I don't get to vote there. I just get to make money on the most beautiful stock market in the world and take advantage of the greatest economy that is out there. And I'm very, very grateful for that. And grateful for you guys. But after that, I see inflation staying high. I mean, they're going to say it's 3 to 5% officially, but we all know the official numbers are, massaged. And therefore, I believe asset prices are going to rise very tremendously. We're going to take advantage of that tremendously. And we essentially end up with a new monetary system where we just get this permanent inflation again. In the last 20 years, we had no inflation. We had 0 interest rates. Interest rates are going to stay somewhat higher. Inflation is going to be elevated, and that will reduce the value of your money, your cash, your salary, and debt. So who's going to make money here? Who's going to come out of this swinging? Well, the debt people. So all the super high leverage stuff out there is going to win, but it's also going to just incentivize the craziest amount of risk taking ever seen. So it's a funky world that we're going into, but I think how we position ourselves is kind of obvious. First of all, audit your portfolio. Know what you're in, right? Look to maybe move towards inflation protected assets. Make sure you got rules and stops and rules. Join me Saturday. It's free. felixprehn.com/training. Learn. And then you got to monitor these Fed signals like this one here. Just monitor the private credit data. Again, if you don't know where to start that, join me Saturday and I'll give you some pointers. And take action. Right? Most people in every crisis sit on the sidelines and go, oh, it'll be fine, I hope. What if it isn't? Oh, I don't know, right? Don't be that person, because they suffer and it's not necessary. Money is a skill. It's about as hard as learning to play, I don't know, football or tennis or something. Actually, it's probably quicker. Actually, just quicker. But it's something you need to learn. You need a coach. That's all I'm saying. Come and join me Saturday, felixprehn.org/training. If you got some value out of this, share it with other people. Because if we shared that video from 2 days ago with more people, less people would have been surprised yesterday. I wish you all the best. I woke up this morning to these news alerts on my phone, courtesy of Trade Vision, and it says to me that everything's just changed. Everything till the end of the year, Santa rally, all that